Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Today, I'm going to talk about why the number of Fed rate cuts this year may matter less than you think. It's Wednesday, March 5th at 2 p.m. in London. Financial markets spend a lot of time discussing the Federal Reserve. And for good reason. The central bank of the world's largest economy plays a central role in fighting inflation and setting interest rates. And what they'll do this year is topical and shifting. At Morgan Stanley, our economists think that U.S. tariff and immigration policy will lead the Fed to keep rates somewhat higher for somewhat longer than they did at the start of the year. Yet we think there may be just a little bit too much focus on just how much the Fed changes policy over the course of the year. Indeed, we'd go as far to say that, given the choice, investors should be rooting for less change, not more. To start, for all that has happened in the world since the end of October of 2024, expectations for the Fed's interest rate path have been remarkably stable. The U.S. two-year Treasury, which is a decent proxy of where the Fed's rate will average over the next 24 months, has hovered in a very narrow range. It simply hasn't been telling us very much. Other factors have been moving markets. There's also a pretty reasonable rule of thumb from history. Stability is good. A stable Fed funds rate almost by definition implies a stable equilibrium that doesn't involve overly high inflation pushing rates further up or overly weak growth pushing them further down. The best growth in recent history, in the mid-90s, occurred after the Fed reduced interest rates less than 1% and then kept them stable at a pretty elevated rate for a pretty extended period of time. Large changes in rates, on the other hand, in either direction, are a different story. Some of the market's worst losses have coincided with the largest declines in the Fed's target rate, because those large rate cuts usually occur only when there is a large unexpected slowing in the economy, something markets often don't like. Meanwhile, we think the Fed also very much wants to avoid a scenario where it has to start raising rates again, given the potential confusion that this could signal after it only recently continued to lower them. And so if over the course of this year, the Fed does need to raise interest rates, given the very high bar we think they've given themselves for action, it probably suggests that something unexpected, and not in a necessarily good way, has occurred. Central bank policy will always matter for markets. But for investors, the question of whether the Fed will cut once, which is the Morgan Stanley base case, twice or not at all in 2025 may not matter all that much, at least for credit. Far more important is the performance of the economy and whether big changes to tariffs or immigration policy drive big changes to growth and inflation. Those big changes, which could drive big changes in Fed policy responses, are the scenario that worries us. Thanks for listening. If you enjoy the show, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.